Hello, everybody. Welcome again on a new edition of Kotak Cherry 2023 in Focus. Today, we have a very special guest with us, Mr. Samir Arora, founder, Helios Capital. Hello, Mr. Samir.
Thank you very much.
So, Mr. Samir, directly jumping to the point, 2022 year has primarily been, focused around what crude oil levels are, what inflation levels are. How do you see these two factors playing out in the next year?
So I would think that this year, the biggest issue became primarily high inflation in US markets, which then fed into other markets. And the response of the Federal Reserve is what brought down their market and put pressure on currencies and markets worldwide. So my thinking right now is that in the next 2-3 months, or even before that maybe, the US market would have bottomed out. Why do I say that? Because all the events are now, they are going to basically run out of their interest rate hikes in the next 2-3 months. The market has already done quite badly into 22. Mostly if you look at the time period that it has taken for this duration of bear market or the extent of fall, it is now in line with their history. So I would think that in the next 2-3 months, the US market will bottom out. And once that happens, the rest of the world can move along on whatever are their own fundamentals and flows. And on that basis, I think that next year, India will have positive returns. This year, India outperformed. That was the main story. But in dollar terms, the returns were not positive. I think next year, the returns will be positive, but maybe starting, you can time it with, say, after budget. What I mean is next 1 or 2 months, it should bottom out. The US market, and because of that, pressure on the rest of the world is lifted. And then India resumes its normal 10-15% per annum kind of returns.
Right, Samir. Samir, so there have been talks primarily in US markets that recession is around the corner. A lot of central banks, be it the central banks or the global brokerage houses, they've come up with their opinion regarding there would be recession, whether it's going to be soft landing or not is something which time will only tell. But don't you think that if things don't settle down as expected, inflation doesn't come down as expected, or there be any other major macro uncertainty which evolves, would that not lead to more jittery in the US markets?
So my thinking is that if you look at the US market history, there have been only 4 instances in the last 100 odd years that the market has been negative in 2 consecutive years or more. But 2, let's say. So for me, I've been in the market since 1990s, and there's been only 1 instance, which was in calendar year 2000 and calendar year 2001, that the market was negative in 2 consecutive years. So it is not normal, because there have been recessions in the past, also many more recessions than just 4. I also read somewhere that basically the US market is positive in the year in which there is a recession. The reason for that is that A, it has fallen a lot before. Second is by the time that recession is somewhere along the way, the Federal Reserve starts cutting rates. And therefore it sort of rebounds, but mostly because it's been discounted before. Right now, I think that the US market may have a recession, but at the end of the year, it won't be big negative, if at all. Maybe it's flattish. The reason why it is not like a normal year, where normally normal bad year, where what happens is at the end of the fall, the Federal Reserve panics and they cut interest rates or they inject liquidity, and then the US market rebounds. This year, it is clear that they are calling it higher for longer, which means they may pause at 5% interest rate or 5.25%, but that does not mean the next month they will start cutting it. So therefore, this year, the US market, that means 23, the US market will have these high rates for nearly the whole year. And therefore, I think that the US market in the end will not go up a lot. But it is not that suddenly, unless there's a new event, there's no answer. But for this event where broadly the inflation, you can also see that the inputs to inflation are coming down. That is oil prices, you can say logistics prices, shipping prices, all these things are not going higher.
Right.
And now if China also opens up, which was one more reason why the inflation was high, that the supply chains were restricted. So I don't think inflation will be much higher than this. So This is already known.
Right.
And therefore, the question is that it should slowly come down just by pressure. Housing stocks and housing stock has come down a lot. Means houses prices have come down a lot. Lumber prices, all these things. So you are somewhere in the end game for this, I think. Of course, if some new thing happens, if somebody says, what if there is nuclear, this thing, and all that, or China attacks Taiwan, who knows all those things. But right now, I don't think it's going on for another year.
Right, Samir. Samir, now shifting the focus towards Indian economy, Indian economy has been somewhat resilient. Markets have, depicted that they've handsomely outperformed most of the major global peers. And if you look into 2023, uh, what would be, sectors where you think, markets would latch on to, and sectors which markets would sort of stay away from, considering all the global macro headwinds which are there?
So first thing that India has outperformed this year, which is very good, but broadly India has outperformed for the last 25 years. So in the last 25 years, the Indian market in dollar terms has beaten Mr. Buffett. And the Indian market has beaten S&P 500, and it has beaten China, and it has beaten Asia, and Japan, it's beaten Europe. So it's generally done well all its life. And the return in the past 25 years have been of the order of 14% per annum in rupee terms, which was around 10% per annum. And Mr. Buffett did 9.1 or something, and the US market did 8. So this 13-14% is a fair number. And I think that over the long run, again, you will make somewhere in this range. But looking at any 1 year, it can be up and down. But if it was very smooth, then nobody would invest anywhere else. If you knew always that you're making 14, in the end, you end up making that much. Even the US market, if you see last 25 years, which is up 8% in dollar terms, is effectively 12% per annum in rupee terms. So that number is okay. Now, coming to sectors, basically, there are big picture three themes that the whole world always is invested in, which is financials, consumer, and IT. And we also like the same themes for our own reasons. But broadly, if you see, everything else comes on and off. Right. Everything gets summarized into financials, IT, and consumer. And in India, you can say financials are good because they are anyway the better companies, which includes your company and HDFC Bank and all these, which have been good corporate governance, good growth or whatever, and competing with state-owned companies and winning. The second group is consumer. We have the largest consumers, demographic, lifestyle changes, aspiration, people wanting to go to brands, unorganized to organized, easy to see. And the third one is our IT is low capital intensity. You don't have to first set up like TSMC now announced that they want to invest 40 billion in US. Indian guys don't have to invest any money. And therefore, it is a better business. But we currently don't like the Indian IT sector, which we will, as of now, not like till at least April, May, when these guys give their guidance. Because I feel that currently the Indian economy relative to our other economies is doing better. So I would rather buy Indian economy related stocks than global economy related stocks, when we are separately saying that US might have a recession and nearly every sector is firing, including investment banks, even lawyers, all the tech companies. And for us to say, no, the only place they will not reduce any businesses to Indian IT companies looks unrealistic. So although we like these three themes generally for any period, but tactically today we will overweight financials and a little bit overweight consumer and underweight or very low weight in tech. And then once in a while you buy some other things like specialty chemicals, which these days is a good theme, top down because of China +1, Europe +1, and whatever, that people are moving to India for some part of their this thing. Otherwise, you can say these days even defense is a good sector, but those sectors are 4, 5, 7% of our portfolio, not 20% of our portfolio, whereas these three themes, which is financial, IT generally, and consumer are like 30% of our portfolio in normal times.
Right. 2022 Nifty reclaiming all-time highs. How should a new investor step into the markets at this juncture? How should they go about with investing? Some words of advice to them.
So first of all, in theory, it is always supposed to be at all-time high, because if every year the market historically has given 14% per annum, so if it was smooth, every year it will be up 12-14% compared to previous year. So nearly all time and all-time high. And the second thing is, it is not random that it is up this much. This is the normal earnings growth for a large part of the market. So, for example, if you look at the financials, the private financials, you look at the consumer, or you look at IT, broadly they grow 12 to 18, 19%. Then some new companies grow very high, but broadly the whole market grows that much. If you look at the GDP growth in nominal terms, it is around 10, 11, 12%. So corporate earnings can grow 13, 14%. If you look at another concept called equity risk premium, which is basically saying how much do equity markets do better than fixed income markets. So this is a worldwide factor you can check on Google. Basically, you will just take any market return and then look at the 10-year or long-term bond of that market in that currency, and you just see the difference. Broadly, that difference worldwide for 100 years, for as many countries as you can find, wherever you can find 100-year data, 50-year data, it turns out to be 6-7%. It is just the reality for the last 100 years across markets that the range is some 5.5, something to 6-7. So if you apply that also to our 10-year bond rates, government bond, which is say 7 point something, add 5-6%, generally it would be 13-14%. So therefore, this high, all-time high, maybe if you're already 90% invested, somebody might say, no, wait for the last 10%, you might get better after budget, before budget, like I am saying. That is for the guy who got the last 10%, 5% to invest. We can say, okay, no need to put 100, it's okay, 90 will do your job, and 10 you wait. But if you are starting out, you have zero, you are doing an SIP, there is no discussion. You just put as much as you can in equities, and then along with us, we all hope to get 13-15% from the market. So you will also make it, but that is the market return. Then our job is to beat it by a few percent as fund managers. But broadly, whatever you do in equities, you will outperform your fixed income debt, bank debt, fixed FD return. You will beat normally your property return. You will normally beat your gold return.
Right.
And it is nearly liquid, unlike property and all. So that's why it is a no-brainer for somebody who has zero. For somebody who has 90%, somebody can say last 10%, wait, read newspaper, enjoy life, wait for one day here, there. That's all just to keep everybody busy. Otherwise, there's no discussion.
Right, Samir. No, I think that's it. Samir, thank you so much for your time today. I
Thank you
hope
very much.
our audience will definitely gain a lot of knowledge in basis whatever pointers you've said. So thank you again, Samir, for joining
Thank you
us.
very much. I wish all of you best of 2023 in health and wealth and other things also, love and affection. Thank you very much.
Thank you, Samir.